Now, moving on, let's talk about the different types of orders. Okay, so when you are trading stocks, there are different types of orders that you can use in the market. And I just want to share with you some of the most common ones. There is, more to this four that I'm about to share with you, okay? But I'm not going to cover all of them because it's just too extensive. But these are the four most popular, most common ones that I feel that you should know. They are the market order, limit order, stop order, and stop loss order. So let me explain. Market order, what is it, right? So market order is simply an order, right, that sends to the market right now, immediately, right? At whatever the prevailing ask price is, you will buy it right now. So that's what we call a market order. It means that you want to enter the trade right now, so you use a market order. So the good thing about market order is that you know for sure that you'll be in the trade. Okay, guaranteed, right? You just hit the market order, the broker, right, would send the order to the exchange and get for you the best possible price. So you know for sure you will be in the trade. The downside to it is that you have to pay a premium, okay, because you are willing to, pay whatever the current prevailing price is. So if the stock is moving pretty fast, okay, you might have to pay a slightly higher price, a premium, right, at whatever the asking price is currently is. So this is the market order. Next is what we call the limit order. So a limit order is where you will only get filled on the trade if the price comes to your desired level. So let's say, for example, again, Apple shares, all right? Let's say the current price of Apple is trading at $110. And let's say, you don't want to be hitting a market order because you have to pay $110. So instead, what you want to do is, or what you could do is place a buy limit order at $100. So what happens is that if right, the price of Apple, it declines, right, to $100, then that buy limit order will get you filled at Apple shares. To buy Apple shares at $100. So this is what we mean by a limit order. You only enter the trade if the market comes to your desired price level. So this is good for those of you who trade pullback, right? Limit order is a useful function that you can use. So the pros is that you enter at a cheaper price because you don't have to pay the prevailing market price. You can actually wait for the market to come to a more cheaper price level before you enter the trade. The downside to it is that you might miss the move, because what if Apple right now is trading at $110 and you have a buy limit at $100, but Apple doesn't decline, it moves to 120, 130, 150, 200, 500, and you end up missing the move, right? Because you want to enter at a cheaper price. So that's the downside, the first downside. The second downside is that you are, trading against the current momentum. So what this means is that, let's say, Apple price is at here right now. Okay, let's say this is again $110, and you have an order over here at this $100 level. So what you're actually doing is that you're buying Apple, right, as the current momentum is against you, right? It's against you. It's not necessarily anything bad, but this is something that, again, I just want you to know that is that you will be entering your trade, right, when the current momentum is against you. Okay, so that's so-called a couple of, cons that you might want to be aware of. So that is the limit order. The third thing is what we call a stop order. So a stop order is useful, right, when you want to trade breakout, because you will only enter trades as the market moves in your favor. So for example, okay, let's say the Apple shares has been in a range. Okay, let's say the highs of the range is $100 and the lows is, let's say, $80. So if you use a stop order, right, you can put in a stop order at, let's say, $105, right, over here, $105. This means, right, that only if Apple shares move up and hits $105, only then will you buy the shares. So this is what we call a buy stop order. You only go long, right, if the share price moves in your favor, right, and it hits a predetermined level that you expect. Okay, so if you have a buy stop order at $105, you will only buy the shares if Apple reaches 105. If it reaches 101, 102, 103, 104, you will not buy the shares. It only buys, right, when it hits $105, right? So this is what we mean by a buy stop order. So the pros is that when you are using a stop order, a buy stop order, for example, you are entering your trades with momentum. So you can see that this is actually the opposite, right, of the limit order. So when you buy a breakout, right, let's say you have a buy order over here. You're buying, right, as momentum, right, is in your favor. The downside to trading with a stop order is that it might be a false breakout. So what is a false breakout? So the stock price might, go up, go down, go up, go down. It breaks out and then collapse back into the range. So you end up, buying at the highs over here. So this could happen, right? So again, I just want to, I want you to be aware of it. Okay, so this is the stop order. And finally, is something what we call the stop loss order, possibly the most important order that you'll use. So a stop loss order is unlike the earlier 3 orders where it gets you into the trade. A stop loss order gets you out of the trade. Okay, you exit the trade if the price goes against you. So you can think of this like a defense mechanism, right? If the stock price goes against you, after you hit a certain price level, you're out of the trade. So again, an example, let's say you buy Apple shares at this point, right? Maybe it's $100, and you have a stop loss order at, let's say, $70. So what this means is that if Apple shares, it declines, right, to $70 at this point, you will automatically sell Apple shares because your stop loss is at $70, right? So this is an order, right, that helps you so-called protects your trading account. It prevents you from, getting things out of hand. Okay, it's a defense mechanism. So the pros is that, you cut your losses, you get to live another day. You don't have to, lose a huge chunk of capital because your stop loss, prevents further damage. But the cons of it is that, the market could reverse back in your favor. So, let's say again, market, goes up. Okay, you buy over here, your stop loss is here. Market comes down, hit your stop loss, and then continues higher. So when it hits your stop loss, right, it could reverse back in your direction. So you can see that, man, if I did not use a stop loss, right, I wouldn't have taken the loss. So that's definitely is going to hit your mind, right? But trust me, right, in the long run, it's for you, it's for your own good. Because what if, right, the stock price just collapses lower and never recovers? So again, stop loss, as I've said, right, it's a defense mechanism. It's not 100% foolproof. There will be times where the market hits your stop loss and then it moves back in your favor. And that's simply the cost of trading, the cost of doing business. Okay, so a stop loss order is unique in the sense that it's an order that gets you out of the trade. So a recap, number one, we talk about market order. It gets you into the trade, gets you into the market right now. You simply buy at whatever the asking price is. A limit order is an order that gets you at a cheaper price. You set a determined price level that you want to enter, and if the market declines to that level, you'll enter the trade. That's a limit order. A stop order is the opposite of a limit order. You only enter the trade if the market moves enough in your favor at whatever price level that you determine, right? So a stop order is basically trying to buy a breakout. If the price have moved so much distance within this period of time, your stop order will get you into the trade. And finally, we talk about stop loss order is simply an order that gets you out of the trade to protect you and your trading account. All right.